Wednesday, June 10th, 2020, Maneco 64, home of alternative economics and contrarian views. Today I want to look at the dollar index and its long-term cycles, and this is a part 2 video. Part 1 was done in May last year, and I've looked at the dollar index quite a bit over the years. So I want to reference also an interesting opinion piece by Stephen Roach, who was the former chairman of Morgan Stanley Asia. He also worked for the Federal Reserve Board from 1972 to 1979. Right now, he's a PhD economist at Yale University. So very mainstream, elitist economist, worked for the Federal Reserve, worked for Morgan Stanley, and he's talking about the dollar as well, how the dollar could be entering a bear territory. So before I go into the cycles, let's have a read about Stephen Roach. And he reminded me of what Peter Schiff has been saying for years, that the dollar will go lower and much lower because the United States has been living not within its means since World War II. They've been abusing their exorbitant privilege, as Valéry Giscard d'Estaing said when he was Minister of Finance in the 60s. The exorbitant privilege, of course, of having the reserve currency and being able to create that currency out of thin air and still have foreigners demand that currency. But it looks like things are changing. Even Stephen Roach is saying that. He says the greenback could test its July 2011 lows, weakening by as much as 35%. So let's go through the editorial piece he wrote about the dollar, giving the fundamentals behind his reasoning. The era of the US dollar's exorbitant privilege, there you go, as the world's primary reserve currency, is coming to an end. Then French Finance Minister Valéry Giscard d'Estaing, while he became president as well later, coined that phrase in the 1960s, largely out of frustration, bemoaning a US that drew freely on the rest of the world to support its overextended standard of living. For almost 60 years, the world complained but did nothing. Those days are over. Already stressed by the effect of the pandemic, US living standards are about to be squeezed as never before. At the same time, the world is having serious doubts about the once widely accepted presumption of American exceptionalism. Currencies set the equilibrium between those two forces, domestic economic fundamentals and foreign perceptions of a nation's strength or weakness. The balance is shifting, and a crash in the dollar could well be in the offing. The seeds of this problem were sold by a profound shortfall in domestic U.S. savings that was glaringly apparent before the pandemic. In the first quarter of 2020, net national saving, which includes depreciation adjusted saving of households, business, and the government sector, fell to 1.4% of national income. The other thing I would say about the U.S. savings rate, it's highly skewed towards the top 10% of the wealth percentile. If you excluded the very wealthy from that calculation, savings would be even lower. This was the lowest reading since late 2011 and 1/5 the average of 7% from 1960 to 2005. Lacking in domestic saving and wanting to invest and grow, the US has taken great advantage of the dollar's role as the world's primary reserve currency and drawn heavily on surplus savings from abroad to square the circle. But not without a price. To attract foreign capital, the US has run a deficit in its current account, which is the broadest measure of trade because it includes investments, every year since 1982. So that's almost 40 years. Things that are not sustainable eventually stop. That's my opinion. He didn't say that. The pandemic and the economic crisis it has triggered is stretching this tension between saving and the current account to the breaking point. The culprits, exploding government budget deficits. I've spoken about this recently, how it's very hard to keep things going because of these huge deficits. According to the Bipartisan Congressional Budget Office, the federal budget deficit is likely to soar to a peacetime record of 17.9% of GDP in 2020. I think it could be even higher. We'll have to wait and see, though, before hopefully receding to 9.8% in 2021. A significant portion of the fiscal support has initially been saved by fear-driven unemployed U.S. workers. However, monthly Treasury Department data showed that the crisis-related expansion of the federal deficit has far outstripped the fear-driven surge in personal saving. Intense downward pressure is now building on already sharply depressed domestic saving. Compared with the situation during the global financial crisis, he means 2008, when domestic saving was a net negative for the first time on record, averaging minus 1.8% of national income from the third quarter of 2008 to the second quarter of 2010, a much sharper drop into negative territory is now likely, possibly plunging into the unheard of minus 5 to minus 10% zone. And that is where the dollar will come into play. For the moment, the greenback is strong, benefiting from typical safe haven demand, long evident during periods of crisis. Against a broad cross-section of U.S. trading partners, the dollar was up almost 7% over the January to April period in inflation-adjusted trade-weighted terms, to a level that stands fully 33% above its July 2011 low. Bank for International Settlements data show. Well, I'm going to show you the chart of the dollar index in a minute, but let's finish this editorial by Stephen Roach. But the coming collapse in saving points to a sharp widening of the current account deficit. The key question is, what will spark the decline? Look no further than the Trump administration. Well, he brings in politics here. I'm just giving his opinion. I'm not saying I agree with him 100%. Protectionist trade policies, withdrawal from the architectural pillars of globalization, such as the Paris Agreement on Climate, Trans-Pacific Partnership, World Health Organization, and traditional Atlantic alliances. Gross mismanagement of the current crisis response, together with wrenching social turmoil, are all visible manifestations of America's sharply diminished global leadership. I personally think it's more a case that America is so divided within itself that it's very hard for America to lead the outside world, but he's giving other reasons. When the economic crisis starts to stabilize, hopefully later this year or early 2021, that realization should hit home just as domestic saving plunges. The dollar could easily test its July 2011 lows, weakening by as much as 35% in broad trade-weighted inflation-adjusted terms. The coming collapse in the dollar will have three key implications. It will be inflationary, a welcome short-term buffer against deflation, but in conjunction with what is likely to be a weak post-COVID economic recovery, yet another reason to worry about an onset of stagflation. I've been talking about this, and I'm not a PhD economist. The tough combination of weak economic growth and rising inflation, there you go, that wreaks havoc on financial markets. Moreover, to the extent a weaker dollar is symptomatic of an exploding current account deficit. Look for a sharp widening of America's trade deficit. Protectionist pressures on the largest piece of the country's multilateral shortfall with 102 nations, namely the Chinese bilateral imbalance, will backfire and divert trade to other higher cost producers, effectively taxing beleaguered U.S. consumers. Finally, in the face of Washington's poorly timed wish for financial decoupling from China, who will fund the saving deficit of a nation that has finally lost its exorbitant privilege? In what terms, mainly interest rates, will that funding now require? Like the health crisis and racial turmoil, the fall of the dollar will cast global economic leadership of a saving short U.S. economy in a very harsh light. Exorbitant privilege needs to be earned, not taken for granted. I agree with him on the exorbitant part there. It's been abused for too long. So yeah, let's go to the dollar index. I recommend you watch my video from May last year about the long-term cycles of the dollar index. I go back to the 70s, and I show basically that the dollar index has roughly a 7 to 9 year cycle from high to low and from low to high, 7 to 9 years. And I went all the way back to 1973 when it was created. And the chart goes back to earlier than that. And there was a top in 1969, a bottom in 78. So that's about 9 years. Then there was a top in 1985, which is about 7 years. Another bottom in 92, which is about 7 years again, and then a top in 2001, which was 9 years. And then the bottom in 2008, which was another 7 years. And for me, the top in January 2017 at 103.82, that was a cycle top. And in my video from last year, I said that I expected that to be the long-term top, January 2017, and that we would probably be going lower for the next few years towards the middle of this decade of 2020, somewhere around, let's say, 2023, 2025 or thereabouts. And yeah, that's where I see the dollar index going. And of course, recently it has strengthened during this crisis. As you can see here, I've got a shorter term chart going back to 2015. And you can see that we almost matched that high from 2017 earlier this year, but we didn't go through it. And I think that's quite significant. And you can see how it's turning around now very quickly. So I haven't changed my mind. And it looks like even people like Stephen Roach are starting to agree with me. I know this is a controversial topic, the strength of the dollar, and I'm sure a lot of you are going to say, no, I think it's going to go a lot higher. But I think the Federal Reserve and the Treasury are prepared to really wreck the value of the dollar right now. And why do I say that? Well, they're prepared to continue fiscal stimulus, the Congress and the administration. They're prepared through monetary policy, that's the Federal Reserve, to print as much fiat currency as is necessary to keep things going. The Federal Reserve is also prepared to swap dollars off balance sheet to help other currencies not drop too quickly versus the dollar. So yeah, I agree with Stephen Roach. I agree with Peter Schiff. And I think this is going to put a lot of pressure, upward pressure on the price of gold. I know gold and silver right now haven't really done much. They haven't really rallied as much as you'd think it would with the dollar index moving as it's moving. But I would also say that when the dollar index bottomed in 2008, at just above 70. Gold was at 1,030. And even though the dollar index has gone up since then, gold has also gone up. It's at 1,700. So the dollar is important for the price of gold, but it doesn't always trade exactly in tandem. But I expect gold to do very well, especially as the dollar continues to drop. Just like Peter Schiff said, that once the dollar starts going down, that's when gold will really, really motor up. Does that mean the other fiat currencies are going to go down versus gold? No, I don't think they will. I think gold will go up faster than they're going up against the dollar. So that's the dollar index there and the cycles. And I haven't changed my view of the long-term cycles. So let's quickly look at where the markets are before I finish for the day. We've got the Fed announcement today, and the press conference will be an interesting afternoon, I would say. They come out around 2 p.m. New York time. So it's 8:32 a.m. London. Right now, spot gold is at $17.18, up $3.50. Range has been 1707 to 1721. I think the key level here, of course, is around 1738 and then 1750 on the upside. Silver today is picking up. It's outperforming. Yesterday, silver didn't have a very good day. We're at 1770, up 18 or 1%. The Dow is up 133 points. The Dow future, or 0.5%, at 27,400. Sterling is up just under 1/3% at 127.65. The euro is up 0.1 at 113.53. The dollar is down 0.4% versus the yen at 107.32. WTI crude is down 2% at 38.24. And to finish off, the 10-year yield is continuing to drop, actually. As I said, that 1%, in my opinion, is a very key level. I don't think the bond markets, the corporate bond markets, the stock market, or even Uncle Sam could afford 10-year yields too much higher than 1%. So right now, we're almost back to 0.8%, or is 80 basis points. We're down 2.2 basis points. We could see quite a bit of volatility later on today through the press conference, through the Q&A by Jay Powell. I'm sure there will be questions about forward guidance, yield curve control, and all those things. And I think it could be very important for the bond market and markets in general. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.